Welcome to part 2 of chapter 4 lecture, Accounting for Merchandising Operations. Pretty much in the first part of the video, we talked about merchandising activities and I described new transactions related to purchasing, buying merchandise. So now we're going to change our hats, and the hat we're going to wear is going to have a title seller. I'm going to describe selling transactions when we're going to sell merchandise. We're going to talk about sales, sales discounts, sales returns, and allowances. So first of all, I want to remind you of the new accounts I described in the first part of the video. And pretty much, guys, we're going to deal right now with these 3 new revenue accounts. And the main revenue account is called sales. It's just like consulting fees account in the first 3 chapters, normal credit balance. And you also have now 2 contra revenue accounts. I want to remind you, a contra account always travels together with the main account. So if I list sales on the income statement, I have to list contra accounts right under it. And the contra accounts have the opposite signs. So the normal balance will be debit and we will be subtracting them from the main account. And also, guys, there is a new account called COGS, or cost of goods sold, and it's an expense account with the normal debit balance. So let's go through new journal transactions for selling activities. Okay, let me get there. Okay. So accounting for merchandise sales, as I mentioned, these are the 3 new accounts. This is how they look on the income statement. And again, net sales is the sales minus 2 contra accounts. And then from net sales, we're going to subtract COGS, and the difference is called gross profit. So gross profit, it's not an account, it's a subtotal. And the definition of gross profit is the difference between net sales and the cost of goods sold. Because we're using the perpetual inventory system, the sales transaction will now have 2 components. So for every time you sell merchandise, you actually have to record 2 journal entries. One journal entry is going to deal with sales, and we're going to record this transaction at price, right? So I'll put here at price. You will always be given 2 amounts. We will always assume price is higher than cost. So this one will be recorded at price. And then the second transaction will be recorded at cost. We're going to recognize cost of goods sold, and we're going to recognize the decrease to merchandise inventory. So again, every sale of merchandise will have 2 transactions. And I don't think we've seen anything like that, but this one business transaction requires 2 journal entries. So here's an example. We, Zaymart, sold 1,000 merchandise on credit. This is without discounts. And the cost is $300. So you see, you're given the price. That's your selling price. So the first transaction you record, you debit AR credit sales. Just like we did in the first chapters, we sell on account, on credit, debit AR, credit sales. Usually, as I said, right here, you will also have to specify accounts receivable dash what's the name of the customer. And the second transaction, guys, they just recorded one under another, right? And the second transaction deals with the cost side. So that $300 goes to COGS, right? So when I sell merchandise, my COGS cost goes up. So what's gross profit from this transaction? Sales minus COGS gives me the markup, or gross profit, which is $700, and you also decrease inventory, right? So every time you have a sale, what happens with the inventory? So any type of sale, we also have to decrease inventory by the amount of cost. So these 2 transactions take care of it without cash discounts. Now this is with cash discounts. In the first part of the chapter, we were getting discounts. They were called purchase discounts and recorded as decreases in the merchandise inventory account. In this part of the chapter, we are giving cash discounts to the customers to encourage them to pay early. So we complete $1,000 credit sale. There it is, right? $300 cost. So again, 2 journal entries from 1 business transaction with terms of 2/10 net 45. So if the customer pays me within 10 days, November 12th plus 10 November 22nd, they're going to get a discount. So if I get a payment on November 22nd, look at the accounts. So I like to start working here from the bottom. You have 2 debits, you receive cash, and you also give a sales discount. And the sales discount is plus minus. It's the contra revenue, plus minus. And you credit receivable because the customer pays off, we collect from the customer. I like to start from the bottom. So how much does the customer owe me? $1,000, since there was no return. And how much discount do they get? Again, I'm going to cross out 2 zeros, right? So 1% is $10, 2% is $20. Where does it go? It goes to the sales discount as debit, and the difference is cash. Cash is the plug-in, right? Cash is the actual amount of money I collect, which is 98% of $1,000 or $980. So again, I go from the bottom up here. In this transaction, I start with AR and then sales discount, and then the plug-in to balance out debits and credits is your cash. If they pay me on December 22nd, I mean, if they pay after the credit period, then cash and AR are the same, $1,000 you see right here, there is no discount. So I hope it makes sense. It's like a mirror expression of the purchases transactions, right? They are really similar, it's just a different side of the coin. And returns and allowances, same story, but now we're gonna accept them, right? So returns means the customer physically sends me back the parts, so I put them back in my inventory. So when we receive sales returns, I actually am going to say right here, sales returns means that, you know, the customer physically ships it back, so I have to debit merchandise inventory. So guys, if it's a return, all I'm going to do, I'm going to reverse both of these transactions. I'm going to flip them over. I'm going to flip them over if it's a return. So I'm going to, instead of debiting sales, I'm going to debit sales, returns, and allowances. And I'm going to credit AR because the customer does not owe me that amount of money. I'm going to flip this transaction. Also, I'm going to debit inventory because I'm receiving the parts back. And I'm going to credit cost of goods sold because the parts are no longer sold. So here is the transaction, right? Sales, returns, and allowances, debit, cash credit, and if they are not defective, merchandise inventory, debit, cost of goods sold, credit. Now, if the customer does not need to physically ship it back to us, I give them an allowance, then you don't need the second transaction. You're just going to record the first transaction right here, sales, returns, and allowances, and cash, because I'm not physically receiving those back. Okay, so, and that's an example of the sales allowance, right? Sales allowance, again, the account is the same, sales, returns, and allowance, and cash right here, or AR, it depends, right? So if the original sale was for cash, I have to give back cash. If the original sale was on account, I'm just going to give them credit on accounts receivable. Okay, so let's go to page 210 and look at exercise 4-4. Page 210, exercise 4-4. So I set it up right here. We have 1, 2, 3, 4, 5 transactions. We are allied merchandisers. We started on May 1st. Macy is our customer. It's our buyer, and we're the seller, right? So let's look at every transaction and record them. So Allied, us, made its first and only purchase of inventory for the period on May 3rd for 2,000 units at a price of $10 cash per unit. By the way, when we purchase this, right, that becomes cost. So this is from the first part of the video. I am buying merchandise inventory for $20,000. And again, they didn't have to tell us 20,000. You just take 2,000 units and multiply by $10. And we bought it for cash, right? So we paid cash, $20,000. So this is the first transaction. The second transaction, let me record this one. Record entry. Second transaction, May 5th. We sold 1,500 of the units in the inventory for $14 per unit. So the total price is $21,000. It's the price, right? Selling price. It's 1,500 units multiplied by $14. Under credit terms 2/10 net 60. And guys, the second part of the same transaction is we also have to record cost of goods sold, right? I want to remind you that the cost of goods sold comes from the first transaction. So the cost is $10 per unit. The price is $14. So our gross profit or our markup is $4 per unit. So two parts of the transaction. The sale price part first, we're gonna debit, we're selling it on account. So we're gonna debit accounts receivable. Again, it should say here the name of the customer, which is Macy's. And it's gonna be $21,000. And then the second one is sales. Guys, in reality, you just skip the line and you record, cost of goods sold merchandise inventory right below it. But in this problem, the way it's set up in Connect, they just have yet another right here, May 5th. So one transaction on May 5th and the continuation. So we're going to debit cost of goods sold. That's an expense, goes up. How much? Again, let me go back here. We sold 1,500 units multiplied by $10. So that would be $15,000. That's cost, $15,000. And we're going to credit decrease merchandise inventory, $15,000. So I hope it makes sense. It shouldn't be that difficult. Again, record, couple more entries. Macy returns 125 units because they did not fit the customer's needs. So they physically return it. So I have to have two transactions. The first transaction, I'm flipping my original sale. So sales becomes sales, returns, and allowances debit, $1,750. And accounts receivable is decreased, $1,750, credit. So again, if you think about this transaction, it's the reversal of this original sale. We flip it over. But the customer is not returning all units. They're only returning 125 units. And then Mary return. Okay, so let's record this one. And the second part of the same transaction, we're going to debit merchandise inventory because we reinstate the units in our inventory. That's cost. And cost of goods sold, $1,250. Again, price and cost. Again, I hope it makes sense. A lot of your homework will include these types of transactions as well as the test. And then the last one, Macy discovered that 200 units are scuffed but are still of use and therefore keeps the units. Allied sent Macy credit memo. So this is an allowance, $300, right? So all we have to do, we just have to do sales returns and allowances, debit $300, and we're going to credit accounts receivable. Accounts receivable, and there is no second transaction for merchandise inventory and cost of goods sold because we are not physically receiving it. The last one, we received the payment, that they owed us on May 5th. So this journal transaction to record the cash payment can get a little complicated. Let's put the accounts first. I'm going to collect cash. Cash will be debit. I'm going to give a discount, right? So it was May 5th. Let me see right here, May 5th, 2/10. So if they pay me up until May 15th, and they're paying on May 15th, so I will have to give them a sales discount, and I'm going to credit accounts receivable. But the question here is, how much accounts receivable is that? Originally, it was $21,000. But then what happened, the customer made a return, so accounts receivables, let me go right here and show you a calculator. Okay, so again, accounts receivables originally was $21,000, but then the customer made a return of 1750, so I have to subtract it, right? Credit 1750, and then I also gave the customer an allowance right here of $300, which also decreases the AR they owe to us, minus 300. That's the amount. So what do they owe us? What does Macy owe us? 18,950. And I will start from the bottom, right? 18,950. I think it's easier to start from the bottom. And then we give them 2% discount. So if you multiply 18,950 by 0.02, that's 2%, that's $379. That's the sales discount. And then the difference is the check we are receiving. So if you take 18,950 and you subtract the discount, that gives us the amount we're missing in cash, which is $18,571. And that's it. So that concludes this exercise. So I hope it makes sense. Practice will make you really comprehend the material. Do not try to memorize. Accounting cannot be memorized, right? In accounting, you have to understand what you're doing. Okay. So that concluded our new journal entries. We're going through the cycle, right? Analyze business transactions, journalize them, post to the ledger, prepare trial balance. None of that changes. Now, financial statements, I showed you the differences. And now I need to talk about adjustments. And there's just one new adjusting entry. So we still have adjustments for supplies. Some of you struggled with adjustments in Chapter 3. I know it was an overwhelming chapter, but they will not go away. You need to know how to adjust for supplies, prepaid expenses, depreciation, accrued expenses, accrued revenue, deferred revenues. But in addition to those adjustments, companies that have inventory must take a physical count at least once a year. But most companies do it more often. I work for a manufacturing business that did inventory once a quarter. If you go to large retailers like Walmart, they're doing their inventory count all the time. At night, it's counted constantly. And so the physical count usually does not match the merchandise inventory account. So when I get to the end of the period, this balance right here, ending balance, is not what I physically have in the inventory, right? So I look at this ending balance. Let me extend it right here. I look at this ending balance, and I'm going to compare this ending balance. I'm going to compare it with physical count. And usually physical count is going to be lower because of theft, because of the obsolete items, because of the the misplaced items. And so I need to adjust this inventory account down to the physical count. So we're going to make an adjustment. We're going to make an adjustment so that our merchandise inventory balance is equal to the physical count. And it's called shrinkage, right? Shrinkage. So what do you debit? You debit cost of goods sold, even though you didn't sell it, but whatever items are misplaced or lost or stolen, it goes into COGS, and you decrease merchandise inventory. Let me actually show an example. So let me go back right here. So the adjustment will be right here. Adjustment for shrinkage. It will decrease inventory and update my ending balance. And so now the ending balance will be equal to the physical count. So let me show you an example. It would be quick study 4-9, and that will later lead us to the closing entries. So quick study 4-9, and it's on page 207. 207. Quick study 4-9. So we have Nixit Company ledger, July 31st. It's the fiscal year end. These are normal balances. And look at merchandise inventory. So my records show that my inventory should be 37,800, but when the company makes a physical count, the reality is that you only have $35,900. So look at how much the difference is, and that would be your shrinkage. Simply subtract them, and the difference here is $1,900. Where does it go? This $1,900 goes as a debit. So some companies use the account called inventory loss or inventory write-off. We're gonna put it directly into cost of goods sold. So what does shrinkage do? We hate it, we don't like it, right? It increases my expenses, my cost of goods sold, and it therefore decreases our gross profit. And what do I do with merchandise inventory? I decrease it. So after I make this adjustment, if you think about the T account, inventory was 37,800 debit minus 1,900 credit will be equal now to 35,900. And that amount will be reported on the balance sheet. So equal to the physical count. Guys, also right here, notice that cost of goods sold is no longer $105,000, right? It goes up. It goes up by the amount of shrinkage. So now my cost of goods sold will be $106,900. This is important. This is a typical mistake because we're gonna now do closing entries and we have to close cost of goods sold, but we have to close 106,900. The closing entries are recorded after the adjustment. Okay, so I hope it makes sense, and let me go into the closing entries. Guys, the closing entries are absolutely similar to what we studied in chapter 1. We have to get rid of all temporary accounts, and temporary accounts are abbreviated as RED. R for revenues, E for expenses, and D for dividends. The only difference is that now my main revenue account is called sales, and guys, you have two additional contra revenues, and you have one additional expense. If you think about contra revenues, they look like expenses. They have a normal debit balance. So the most efficient way is to close out all contra revenues as well as COGS as well as expenses in the second step. First step, debit sales, move it to income summary, so sales becomes zero, right? It zeroes out. Second step, zero out all of these expenses and contra revenues. They have normal debit balances, so when we offset them, they become zero. Move the total into income summary. Look at the first step and second step. The first step represents total revenue. The second step represents total expenses. The difference is positive, so we have net income. Subtract it in the third step, move that net income. Again, where does it come from? It's 321,000 minus 308,100 gives you net income. If you have net income, it must be credited to retained earnings because net income increases retained earnings. That's your equity, right? If you had net loss, you flip them. You debit retained earnings because that loss decreases equity. And in the last step, you move dividends, close them out, and move them as a negative. Dividends decrease retained earnings. So you debit retained earnings by the amount of dividends. Okay, so let's go back to the quick study we just did for 4-9, and it naturally continues into 4-10. So in 4-10, it's the same thing. But remember, COGS is now 106,900, right? After the adjustment. So they're asking us just to do the first two steps. They don't want us to do all 4 closing steps for whatever reason. On the test, I will ask you to do all 4 steps. So first, I have to close sales. So sales, I move it into income summary. So let's look up how much sales are. 160,200. So let me put it right here. 160,200. 160,200. That's it. That's my first closing entry. Oops. My first closing entry. There it is. The second one will be long, right? So I'm going to debit income summary, but I leave it alone. I don't know the amount until I add them all up. And guys, let me see. Do I have sales discounts? Yes, I do. Do I have sales returns? Yes, I do. So I'm going to list sales discount. The order is unimportant. Discounts, sales returns, and allowances. Let me do the amounts right away. So sales discounts 4,700. So when we credit this account, it becomes zero, right? The balance is debited, we credit it. Sales returns and allowances are 6,500, and then we have COGS, cost of goods sold, which again, typical mistake, the student puts only 105, it should be 106,900. 106,900, because it was increased when we adjusted for shrinkage. And then your expenses, there's 3 expenses. I'm just going to copy them: depreciation, salaries, and miscellaneous. So depreciation expense, salaries expense, and miscellaneous expenses. So let me do depreciation is 10,300, and salaries expense is 32,500, and miscellaneous expenses is $5,000. So I'm going to add all of these credits together: 4,700 plus 6,500 plus 106,900 plus 10,300 plus 32,500 plus $5,000. It gives me 165,900. Goes right here, and we don't need to do steps 3 and 4. So these are just our first 2 steps of the closing entries. And guys, if you look here, if I ask you to do the next step, you can see we have a net loss, right? Your revenues are lower than your expenses. And so the net loss is $5,700. So in the third step, I would debit that loss, 5,700. I would debit it into retained earnings and credit income summary. Okay, let's finish up this chapter. So the last 2 things in this chapter, so we're done with the accounting cycle for the merchandiser. So in the next chapter, chapter 5, we're just going to start traveling down the balance sheet, and we're going to look at the most important assets and then liabilities and then equity. So the whole chapter 5 is just going to focus on inventory, merchandise inventory, as well as COGS. We're just going to focus on one group. We're going to drill in. So far, the first 4 chapters, they were very broad, very general. We covered a lot of information. Starting with chapter 5, we're going to drill into those items on the balance sheet. So chapter 5 will be focusing on inventory. Chapter 6 will be focusing on cash. Chapter 7 will be focusing on receivables, and so on and so far. These are your 2 ratios that you need to know for this chapter. Asset test ratio relates to current ratio. It's more strict than current ratio. And so asset test ratio, it looks at the company's ability to pay for its short-term debt, to meet its short-term obligations, right? So it's a great ratio to use. In chapter 3, you used current assets over current liabilities. This ratio, the only difference is that you're not using all current assets. You're only going to use so-called quick assets. And they're quick because they quickly will become cash. So this is a measure of liquidity. How liquid is the company? Can the company pay for the current liabilities, which are bills that come due within a year? So the denominator is the same. What are the quick assets? Whatever you have above inventory. So it's usually these 3 groups of accounts: your cash, your short-term investments, and your receivables. Some companies don't have short-term investments, right? So it's anything above inventory. But if you think about them, cash is liquid, cash is cash. Short-term investments, we will sell them within 60, 90 days, and they will become cash. And receivables, hopefully, we will also convert and collect into cash within whatever our policy, 30 or 45 or 60 days. So all of those groups really show you how much cash or near cash items the company has. And usually the rule of thumb is, if this ratio is 1 or higher, the company has good liquidity. For every $1 of current bills, the business should have at least $1 in quick assets. If it's below 1, the company is not doing well. And so right here you can see JCPenney, which I just learned is filing for bankruptcy. And you can see that in 2010, 2011, it was doing well. But then the liquidity is decreasing. And now for every dollar of bills, they only have about 60 cents. So they have to come up with 40 cents on the dollar. So they have to borrow money or sell assets, or they have to. That's what finance does. As in accounting, we provide data, information, and then the finance people make decisions. And then, guys, the second ratio is called gross margin. It relates to net profit margin from chapter 3, but instead of taking net income and dividing it into net sales, we take gross profit, which is net sales minus COGS, gross profit, or many companies call it gross margin, right? So from $1 of sale, it shows you how much the business has left after it paid for its inventory. It's a measure of profitability. So right here in 2010, you can see that for every dollar of sale, the company has 39 cents left after they pay for inventory. So what's COGS? COGS is then, 61 cents on the dollar, right? 61 cents on the dollar. That's cost of goods sold. And so what's left, 39 cents, that's gross margin, and then we're going to pay for expenses. And then you can see where it's going down. Now it went up a little, and so now it's about 35 cents on the dollar. So of course, and another way to look at it, it's a percentage of dollar sales available to cover expenses and provide net profit. The higher gross margin means the company is more profitable. And this concludes chapter 4. Thank you so much.